Hello, Ed Yardeni here. Hope you're all well. Today is February 21st. It's Tuesday. Hope you enjoyed the long weekend. Well, lots to talk about. I guess there always is in our business. It's really extraordinary the way things can evolve and sometimes change pretty rapidly. So back in January, life was pretty simple. You just had to decide whether you were in the soft landing camp or the hard landing camp, and that was it. Markets seem to have signed up for the soft landing camp, the idea that the economy would slow but wouldn't fall into a recession, and the bond yield kind of stabilized around 3.5% there for a little while. And then in early February, we got this onslaught of very strong economic indicators, starting with January's very strong employment report. That was a pretty strong tip-off that we were going to have a strong retail sales report, which is what we had. And we even had a tip-off of the employment numbers that industrial production would be up instead of down. Manufacturing was up 1%, mining was up 2%. It was utilities that was down almost 10% because of the warm weather. So it's conceivable that some of the recent strength in the indicators is weather related, but there's so many of them that suggest that the economy is doing just fine that all of a sudden we have to consider not two scenarios, but four scenarios. So now there's the still the soft landing outlook. I would say this is totally unscientific, just a way of sort of conveying my subjective assessment. So I would say the subjective probability of soft landing is 40%. I know that's down from 60%, but keep in mind, I've got to add up four scenarios to add up to 100% probability. So soft landing, 40%. Then we now have the no landing. And in the no landing scenario, the economy doesn't slow much. It kind of continues to grow reasonably well, around 2.5%, 3%. But in this, there's two no landing scenarios. The one that I'd like to consider as sort of consistent with a soft landing is a hard landing. I'm getting myself confused. Is a no landing with disinflation. I know that seems like a stretch. People can't believe that we could have the economy growing and inflation coming down, but I think that's a reasonable scenario that has to be added to the four, and let's make that 20%. So 40% plus 20%, 60% is still relatively optimistic about inflation coming down, about the economy doing reasonably well, about earnings hanging in there, not going into a recession death dive. So those are those two. Now, the alternative bearish ones that we should consider, of course, is the inflationary no landing. In this scenario, which I think to most people probably seems a more likely combination than having no landing with disinflation. The alternative is no landing with inflation. And that scenario is really just a long way to a hard landing, because clearly, if we have the economy doing well as it's doing now, and inflation not continuing to moderate, but actually starts to show persistence or it actually starts to go up, then I think in that scenario, the Fed clearly is going to conclude that the only way to bring inflation down is with a recession, and that they have to raise interest rates, continue to raise interest rates rather aggressively until a recession is the result. I'm giving that 20%. In that scenario, the Fed would not be doing 25 basis points at the next FOMC meeting, but would do 50 basis points, and may continue to do it at that pace until the economy gets crushed and bringing inflation down. Not a happy scenario at all, and probably the worst of the lot, in the sense that in that scenario, bonds do badly and stocks do badly. Then the fourth scenario is one where we have we go into a hard landing. I mean, a hard landing seemed to be the consensus view, was widely expected, anticipated, that we would just go straight into a hard landing. If not during the spring, then during the summer, consumers would run out of their excess saving. And it wasn't clear to the hard landers that the purchasing power of consumers wasn't solely dependent on the excess savings that they had accumulated during the pandemic, and as a result of the helicopter money of all those relief checks that were dropped. There's the more traditional, old-fashioned notion that if the economy continues to grow and jobs continue to grow, that clearly creates purchasing power for those who were unemployed that suddenly have jobs. And then another source of purchasing power is that wage and price inflation go down, but price inflation goes down faster than wage inflation. So then you can have increases in real wages. But the hardlanders just looked at the leading indicators. They looked at the Fed's aggressive tightening and concluded that we're going to see a recession sometime this year, if not sooner than later, but it's going to happen. So there you go. You got those four. Take your pick. I'm picking the soft landing. I'm giving you 40% subjective probability. Everybody's free to come up with their own subjective probabilities. What that would entail is that some of the strength that we've seen in the economic indicators of late, the no landing indicators, start to weaken up ahead here. Again, some of the strength was weather related, but some of the strength was also undoubtedly related to the Social Security payments were increased by almost 9% to 70 million people. And that, I think I calculated in the QuickTakes, accumulates to $171 billion in additional spending money for the Social Security recipients just this year alone. So there you go again, helicopter money from the fiscal authorities, and that is going to be ongoing. But it's going to have statistically, it's going to have a sort of a one-shot impact on the personal income data that comes out for January, which we'll have at the end of this month. But speaking of that personal income release, we're also going to have the consumption deflator. We know that the consumption deflator inflation rate tends to run below the CPI inflation rates, primarily because durable goods inflation in the deflator runs lower than it does in the CPI. In addition, medical care inflation runs lower in the deflator than in the CPI. And rent inflation is identical, both for primary residence rent and owners occupied rent. However, the weight of rent is much lower in the deflator than it is in the CPI. I hope you got all that, and I hope I got it all straight. A lot of balls in the air here, clearly. Well, let's look at some of the charts that give us some insights into where we're heading with all this, where we are and where we might be heading. So here we go. Let me wet my whistle here. We have a chart here of U.S. industrial production, showing you manufacturing, mining, and utilities. And this is the interesting one. Utilities down 10%. Apparently, it was a pretty mild January. It certainly was in New York, but we kept watching the news and the evening news. And the evening news now is just a combination of a couple of minutes on geopolitical events that might eventually destroy the planet. And after they spend a few minutes on that, they go straight to the weather. So I was under the impression that the weather was pretty awful in most of the country during January, and I was kind of patting myself on the back for living in New York, at least southern New York, where the weather has been remarkably mild. On the other hand, the taxes are awfully high. But so anyways, this was an indicator that we had a very mild January. And as you can see, the manufacturing number here, well, I don't know if you can see it, but it did tick up, and it's a pretty decent tick up. It was 1%, and the mining was up 2%. Now, when we look at the industrial production release that the Fed comes up with once a month, well, we do look at all the components, not just the ones I just showed you. And some of them, I think, are just going to continue to be structurally strong. Industrial production of defense and space, as you can see, an all-time record high. We put this on a ratio scale. We showed you some shades for different presidents to show you what was going on with regards to the White House. But here we are, especially with what's going on in Ukraine and China. That's going to continue to be a source of economic strength, unfortunately. Not if you own the stocks, I guess. Industrial production of aerospace and miscellaneous transport equipment. That's not at a record high, but it had a big increase in January. And there have been a lot of orders for Boeing jets and other civilian aircraft and peripheral support equipment. So that looks like it's going to remain strong, whether we have a hard landing or not. This is not the tech wreck. I know it felt like the tech wreck during most of last year when the tech stocks were getting pummeled. But as you can see here, we have total industrial production of high-tech equipment. And this is should be on a ratio scale, but then things get pretty messy. But this is a pretty significant drop back here. There was another drop over here. This is looking weakish, but a lot of that is semiconductors. And that just may be just a glut, too much ordering of semiconductors after there was a shortage of them. Meanwhile, industrial production of computers and communications equipment, all-time record highs. So that's certainly, you look at some of the green and the blue lines back here and during the tech wreck, and that was clearly a tech wreck. The communications equipment was especially sort of the epicenter of all that, because communications equipment did seller financing, which is a great way to boost your sales, but it's not a very reliable to keep them boosted once everybody's got what they want. And again, even back here during the housing wreck, we had a tech wreck. Computer sales were particularly weak back then, and so far so good. Things look pretty good on the IT side, at least in terms of industrial production. Here's another interesting chart, which is supportive of the soft landing notion. Look at construction supplies, industrial production of construction supplies. This was a free fall here during the housing recession. And here it just doesn't look like a free fall so far. It actually ticked up in January. And we know that housing starts have been very weak, but multifamily has been strong, and non-residential construction has been holding up pretty well. So this is another indicator that things aren't as dire as the hard landers have been saying. A lot of them have been saying that housing is always the epicenter of recessions, and we've got a terrible housing recession. And I've been trying to be a little bit more detailed about it. So that's true for single family, not true for multifamilies. And then there's also residential, non-residential. So you can see non-residential is at a record high here. It's a little bit biased because this is not, it's not inflation adjusted. So inflation adjusted, it obviously may not be as strong. But the fact is, in current dollars, money is being spent on non-residential construction. And I think public construction has only one way to go, and that's up because of all the infrastructure spending dollars that have been committed by Washington. The homes and home improvement construction is down. Home improvement is down. We saw that maybe in the Home Depot announcement today that the revenues are disappointing. But meanwhile, the big surprise, it wasn't really that big a surprise once you look at our earned income proxy. Our earned income proxy comes, we compile with when the employment numbers come out, and the employment numbers are very strong. The wages were decent. And in addition to that, the average work week was up a lot. So there was a lot of purchasing power according to the earned income proxy, and it showed up in retail sales. And again, there's also the Social Security payments that started to be boosted because of last year's inflation. I think some states actually paid out some more of these inflation relief checks. They used to be pandemic relief, but now they're inflation relief checks. And so we did see in, again, there's, I hope I'm not giving you too much information overload here, but this is retail sales in current dollars ticked up 3%. That looks pretty impressive. Not quite so impressive when you sort of look at the trend, but if this is the beginning of an upward trend, obviously that is impressive, but maybe not. This is excluding motor vehicles. But in this case, I do want to show you what it looks like when we inflation adjust it. First, another tip off the retail sales are going to be strong in January, as we did get January auto sales, and they were very strong. I think some of that is that the parts shortages are over. They've abated, and now Detroit's able to deliver cars much more rapidly to satisfy demand, especially the light trucks. So here's real retail sales adjusted for inflation using the CPI goods, which we have through January. And so here you can see total retail sales adjusted for CPI goods up quite a bit in January, but kind of range bound, if you will. And then we've got the retail sales, the core retail sales, so-called, excluding building materials and food services. And you can see that that's actually still on a downward trend. So it's not completely obvious that these numbers are undoubtedly signaling a strong no landing scenario. They still are consistent, I think, with soft landing. Retail sales food is included in the retail sales numbers. And so there's food that people buy at the stores, and then there's food that we get at restaurants and bars. And you can see that this has been a huge increase in January. And again, that could certainly be weather related, but it could also be related to the fact that the income numbers looked pretty strong, and they went out and had a drink and a steak. This is the same thing per household. We only have the number of households through December, and it just gives you another view that Americans now spending a record $8,200 a year on restaurants. And you can see that this has been a converging trend until the pandemic, and now since the pandemic, we're spending more on restaurants than we are on food at home. Nobody cooks anymore, right? Or we bring in. So this data also came out. This is the one that the hardlanders have been pointing to, the leading economic indicators. According to leading economic indicators, on average, if you take an average of how much they lead recessions, it's 12 months. So we should be experiencing a recession right now, because 12 months ago, leading indicators peaked, and they're still falling. Meanwhile, the coincident indicators rose to a record high in January. So, I mean, it's not out of the realm of possibilities that we could still have a hard landing or an inflationary no landing, which inevitably becomes a hard landing. And that's 40% in my subjective mind here. Again, when you take the year-over-year percent change in the coincident indicators and compare it to real GDP, they track each other awfully closely. It's on the same scale. And right now, we're seeing the CEI up 1.3% and real GDP up 1%, consistent with soft landing. But it ain't over until it's over. I mean, the hardlanders are looking for something like this to happen again. And I'm really looking for more of the mid-cycle slowdowns. We sort of had a mid-cycle slowdown in the 60s. There was one in the mid-80s here, this one here. Then depending on what data you look at, there seemed to be kind of a prolonged slowdown after this recession, because the S&L industry was in trouble and commercial real estate was in trouble. Then over here, we had this energy related soft landings, growth recession, mid-cycle slowdown. And that's what I'm anticipating this time around. Looked pretty good a few weeks ago, and now all of a sudden we have to consider the possibility of no landing. And the two alternatives there. Let's quickly just go through the inflation charts here. And I think they're still showing that inflation is moderating. I know that the CPI and PPI numbers were hotter than expected for the January data on a month-over-month basis. But on a year-over-year basis, we're still seeing a disinflationary trend. This is the PPI final demand, excluding various things, and that continued to moderate. This is the PPI final demand, total goods and services. This is kind of interesting. The goods inflation rate is actually still above the services inflation rate in the PPI. We know that's the exact opposite in the CPI. Maybe it's because the PPI doesn't include rent, for example, which is a big inflation source of inflation in the CPI and in the deflator. Finally, I had to look to make sure it was final. Finally, consumer services price indicators. Now, again, this is services, and it's the CPI, it's the PPI, it's the consumption deflator. This is what the Fed has been obsessed about, that if you look at services and take out housing, then you're left with this kind of core services ex housing inflation rate, and they've been concerned that that's been awfully sticky, very persistent, and that's this number right here. So it's core PCED services ex housing costs. Isn't this fun? There's so many interesting things to do and learn in this business. And Powell, Fed Chair Powell, came up with this and said he's very concerned that it's been stuck here between 4 and 5%. Just for fun, I point out that there are alternative ways of looking at it. This is the PPI final demand for services, which already excludes rent, and that's come down rather substantially, though it is still higher than Powell's favorite measure. And then there is the, here we go, core CPI services, ex rent of shelter. That's the green one, and that doesn't look so good. So we have a lot of known unknowns, and we'll see how they play out here. Why don't I take some questions here? I think we've got about 4 of them, and this time I think we got a little bit more time. So Mike asks, which of your likely scenarios requires the Fed to get it right in terms of not tightening too much, too long, or the reverse, given their track record is not so great? So what kind of bet do you want to make on the Fed getting it right? It's a very good point. I've actually sided with the Fed. I rarely do so, but I looked at the December SEP, the supplementary summary. Let's do that again. SEP is the summary of economic projections that they put out every quarter, and that kind of looked like a soft landing. Economic growth was going to be like 0.5% this year and next year. Inflation was going to moderate. The Fed funds rate would stay at 5.1%, would go up to 5.1% this year and stay there through the end of the year, and then down to 4.1 next year, and 3.1% for the Fed funds rate in 2025. That still kind of makes sense to me. This is a soft landing scenario. I think much is going to depend here on how they're interpreting the data. If they recognize that it's just this latest batch of data that's been strong on the economic side and hotter than expected on the month-over-month side for inflation, they could very well, change the rules and say that they're going to go for 50 basis points and 25 instead of 25 basis points. And there've already been a couple of Fed officials that have indicated they'd like to see the Fed go in that direction. So we'll have to see if there'll be more talking heads coming out of the Fed, basically indicating that. But I really don't have a problem getting to 5.25% sooner rather than later. I think if they perceive that they've got an inflationary no landing scenario, I think that's the one where they could get it wrong by tightening too much. If in fact it turns out they overreact to that doesn't turn out to be the way things actually play out. That they really do play out with a moderating no landing scenario. Moderating inflation, no landing scenario, or the soft landing scenario. But the way they would get it wrong is just raising interest rates aggressively, concluding that there is no narrow path to nirvana here, that the only thing they can do is push interest rates up to whatever level it takes to cause a recession, because that's the only way to bring down inflation. And we've already seen inflation coming down on consumer durable goods and consumer non-durable goods without a recession. It's the services that's sticky, but I think they're going to moderate as well. But the problem is these Fed officials, they should just take a vacation. We need a permanent gag rule, not just kind of these short-term blackout periods. They feel like they got to do something, and so they chatter a lot, cause a lot of volatility in the market. And I think we'd be better off if there was only one spokesperson for the Fed, namely Fed Chair Powell, and he only spoke after the FOMC minutes and left it at that. But no, they feel that communicating what they're going to do is vitally important to the stability of the financial system, and I think they, in some ways, create more instability. But there I go, talking about the Fed. Michael, B of A strategist Savita ran a long-term chart showing that interest rates are near historical lows dating to 3000 BC. Comment on mean reversion, rates higher and bonds fall from here. Yeah, I look, I don't know if we're going back to Babylonian times, I guess. I'm perfectly happy looking at interest rates in the here and now. I mean, the economy in Babylonia, centuries ago, was different from our economy. The demographics are different. The global interactions are different. So I have no problems looking at the current situation since World War II. And I think what we've seen of prior to the pandemic and prior to the great financial crisis, well, even before, following the great financial crisis, 3 to 4% seem to be fairly normal bond yields. I think much is going to depend on inflation. I was at a conference yesterday speaking, something called the Money Show, with Daniel Fuss, who's a very well-regarded bond portfolio manager, great record. And he said he keeps it simple. He just says, whatever I think inflation is going to do, I add 2% to that, and that's where the bond yield should be. So he thinks inflation's going to be stuck at 4%, and so he thinks the 10-year bond yield should be 6%. And it's unnerving because the guy's smart and he's got a great track record, and the distance between where we are now at about 4% and the bond yield and 6% is substantial in terms of having a pretty dramatic impact on slamming the brakes on the economy and pushing down earnings and pushing down the valuation multiples. That's not my scenario. I think we're going to get down to 3 to 4% by the end of this year. I'll take the 3 by the end of this year. That would give us a potential risk of 5% on the bond yield. But I think it's the moderating trend will persist and will be apparent. And I think we could get to 2.5%, 3.5% in 2025. But then I tend to be an optimist. Okay, Nicholas, various financial conditions indexes are looser today than they were in March 2022, despite all the Fed has done over the past year. What gives? I actually wrote a piece on financial conditions last week. And so I went through all that, and I pointed out that the financial conditions that seem to have been loosened the most have been the stock market, because it's rallied since October 12th, and the bond yield, which came down to about 3.3, 3.4%. And I think that was the financial markets actually expressing a vote of confidence in the Fed that they might actually be able to pull it off, that they might actually be able to give us a soft landing with inflation moderating. But with the strong economic indicators that came out, that changed. So financial conditions just tightened pretty dramatically here. If you look at the bond yield going up by basically 50, 60 basis points in a heartbeat, and the same thing potentially for the stock market. It has a potential for correcting or going down on this sell-off. Again, I still think we bottomed on October 12th. I think we are going to see the market volatile in a sideways direction on concerns about what the Fed's going to do, whether it's going to be 25 or 50, and then how long is that going to go on, and then the concerns about is it a no landing or what. So that's what's going on. But you look at what the loan officers survey is saying, and they're saying that they're tightening up lending conditions. I guess if you look at credit spreads, they still suggest that conditions aren't all that tight. The mortgage market seemed to the yield came down, but now the mortgage yield is going back up, and that could slam the brakes right back on whatever recovery we were starting to see in today's existing home sales, mortgage applications, and the like. And then, of course, there's the dollar. The dollar was weak, easing financial conditions, but now the dollar's been strengthening of late. Okay, Gary, what do you make of the inverted curve that has great record of tracking recession? I'm asked that all the time. People stop me in the street. No, I'm kidding. The inverted yield curve has a great track record of calling recessions. And again, my pitch has been that what it's really done is call that if the Fed continues to tighten, we're going to get a financial crisis, which then becomes a credit crunch, which then becomes a recession. So far, we've had a few minor financial crises in the crypto market. I mean, we've had a pretty significant crisis in wealth destruction in stocks and bonds, and yet we're not really seeing a credit crunch. And that without that, we're not seeing a recession. So that's what's up with that. I think the financial system is in much better shape to withstand the pressures of higher interest rates, tighter monetary policy than was true in the past. But then again, you never know. Things do kind of pop up out of the blue, and suddenly you get a financial crisis, and suddenly you get a credit crunch. But I'm not seeing that. I'll take one more question here. Doug, are you concerned that the Fed's super core inflation measure is too targeted? It's only 25% of CPI, for goodness sake. And what should they be looking at? LEI, something else? And well, this goes back to one of the questions about whether the Fed is going to be making a mistake here. And, they have, focused all of us on this core services, excluding housing. And it's things like motor vehicle insurance, legal fees, grooming your pet. We got 3 of them, and they're going to put me out of business. I'm going to have to start driving a taxi at night to pay for their grooming because of I feel that same inflation. One last one, Gus, Ed, what are your thoughts on international demand-based China-Europe impact on prices? At this conference yesterday, someone raised their hand and said that they live in LA, and they still see lots of ships bobbing up and down the ports trying to get in, and the truck traffic is extraordinarily heavy. So that certainly jives more with no landing, or maybe a soft landing, but it certainly suggests lots of merchandise is still coming in from overseas. We keep talking about how globalization is finished, but it's finished everywhere but in the trade numbers. We're still importing lots of stuff from China. Europe is importing lots of stuff from China. There's still a lot of trade going on. And I think that's still relatively disinflationary. I don't get the sense that these goods have all been marked up pretty dramatically. Quite the opposite. When some of these goods arrive at the retailers, they're actually marked down because retailers ordered too much relative to consumer demand. Maybe the retail sales numbers shows that whole thing has changed, but we'll see. I'm not that convinced that consumers are ready to go on a buying binge for goods. I think they're still spending on services. So I don't know that that necessarily. I mean, it's sort of caused copper prices to go up. Price of oil hasn't really gone up as much as you would think. So all in all, I'd say the better prospect for the global economy is better for commodity prices, and maybe that's obviously more of a negative for inflation than a positive. But I think commodity prices are still fairly minor determinants of inflation. Well, with that, let me thank you all for tuning in. It was a nice group here today, and let's do this again next week. Have a good week.